Peace Code Keepers, it's time for another great episode of Get On Code, the show where we talk about making sure that we're on top of our game, that we're doing things in a way that will make us more empowered tomorrow. So let's get on code. Let's teach the code. Let's live the code, exemplify the code, share the code. Let's get on code. Hey, today I have one of my mentors of such, one of my peers and another such, and just a good brother Larry Pendleton. And Larry is involved with a lot of investment areas as a CPA, but he's also done some really intriguing things that's really kind of blown my mind. I tell you, we talked at Kezia's event, and when you shared with me about note investing, that blew my mind. I had no idea that that was a thing. So I'm so glad that we get a chance to get you on the show and talk about that as well. Why don't we just jump right into it, Larry? Tell us how you got into the real estate piece, because I know that you were big in real estate investing for a while. Tell me what your experiences were in there, how you got involved, what some of your biggest wins, give up the goods.
No, I appreciate being on Seco. So I've been investing in real estate for around a decade now, thanks to my business partner on the tax side, Tariq Connors, who's a Class A contractor. He's the one that got me into real estate investing. Always knew that it was valuable from a investing and tax saving standpoint from my CPA background, but had a limiting mindset of if I could be an investor myself. And just being connected with Terry and some others just kind of gave me the confidence to actually delve into it. So my first property was a townhome, single-family rental that was in Norfolk, Virginia. Held that on, just sold it last year in 2023. That's probably one of my biggest wins, being able to stay profitable with that first property for so long. But real estate does have its issues as well. I have my mistakes with flipping properties and underwriting other deals. So you take those learning opportunities and do other deals and learn from mistakes. So I've been fortunate to do other small multifamily rentals, short-term rentals, mid-term rentals, apartment syndications, other flips. Even though I had my issues, and now we're more so into buying land and doing new construction locally around us at this moment, and as well as the note investing that I know we'll talk about a little bit later.
Yo, multifamily. I know, I'm involved with flipping, and they're normally single family homes, but multi-family properties are something that I'm really interested in getting into. How did you get involved in multifamily? What are the pros? What are the cons? Just give up the goods.
So the pros is, with any single family rentals, 100% of your income is coming from that one person staying there. And that has its pros and cons of, all right, as long as it's renting, everything's fine. That person's covering your mortgage, the tax, insurance, and you've put in reserves aside the renovations that's needed on the property. So with multifamily, you talking about the scales of economy, like more income coming under one roof helps create more profit a little bit faster, instead of having to acquire multiple single families. And there's a benefit of having multiple single families. It's just that, do you have the proper teams in place? But now you may just have lesser teams involved because you're getting more into multifamily. But you're still having to manage the whoever's your property manager is, or who's doing the construction. Are they equipped to do the construction or renovations on the multifamily, so that if one unit goes out, okay, how quick can you get that turned around? And now you're having to deal with folks who are neighbors, and that can cause some conflicts. So those are some of the cons with multifamily. But I just like the aspect of multiple streams of income coming under one roof. So you try to grow from there. But as you get into larger multifamilies, you want to make sure you're dealing with strong asset management and or property management team that can actually be on site to oversee that. Because you don't want to create a second job for yourself. You can easily do that with single family rentals or multifamily. So either way, it's all about just building the right team.
you mentioned not creating a job for yourself. Is that one of the with the people I know who have multifamily, a lot of them actually even single family homes, and they're doing buy and holds. They try to do everything. But you've said twice, at least in a conversation so far, about having a proper property management team. Did you start off with a property manager, or did you do it yourself at first?
Oh, my first property, I brought in a property manager, and it's just a conversation you have to have with yourself. Like, is because there's a legal aspect to it that most people don't have that knowledge, and it's easily attainable, but you only have so much time in the day. And at the time when I'm starting, I running my tax business. I had a W-2 job, and and I had a family, so you can only have but so much time in the day. And people say, and I enjoy my sleep as well. So why not focus on what I'm great at and bring people on who's great at these other things? So let them be great, and we all can eat from the same table.
Now, were you a CPA before you got involved in real estate?
Yes.
Okay.
Yes, I've been a CPA for nearly 2 decades now.
And you own your own CPA firm?
Yes.
So you understand how wealth is built?
Yes.
How is wealth built? How do people create wealth?
It's all about getting income producing assets. Like, first and foremost, your greatest asset is your mind, because money itself is just an idea. Like anything that generates money for anyone starts off as an idea. So once you're able to come up with an idea, a product, or some type of vehicle to generate money to you, then you're having a stream of income coming in. Now, how are you reinvesting that? Now, some of it is living, I won't say below your means, but just being frugal about your expenses, about what you really need. But then how are you reinvesting those funds and using that money you coming in, putting that money to work to make more money for you? So that's really the basis of how wealth is really built. There's a frugality to it, how you living and not overspending. But there's also, are you taking these dollars that you're coming in, and you're saving up for a rainy day, but is there a actual purpose for each dollar that you have? Because you just can't save into wealth. You have to keep building different streams of income coming in order to get that wealth vehicle started for you.
Yeah, I've heard that every penny should have a purpose. How many streams of income do you have?
Never really. So yeah, the tax business, I mean, I'd probably say between the tax business, the rental properties, and the notes, roughly about eight different streams that we have coming in through our, if you just count the different properties itself.
Okay, that's beautiful. And I think that's something that people should really push for. I was doing a talk yesterday, and I shared with them that in Ecclesiastes it says have 7 streams of income, because you never know what's going to happen. And it just kind of blew my mind that a lot of the people in that particular workshop weren't familiar with that passage. And I can't quote the passage, I'm not that's not my ilk, but it's there. And so for you to say that you have 8, man, you're doing something right, and you're doing something that people should aspire towards doing. And is that because of your CPA background, or what? What got you to the point where you would move towards having 8 streams of income?
Well, I won't say the CPA background has led me to it. It gave me an understanding of the finances, but I think most people would get that even without having a CPA in place. It's really the people I've been able to get around and learn from and absorb knowledge from them that had helped me. Okay, well, we just can't have one property. We got to keep really reinvesting into more properties. because especially if you're doing flips, the flip comes and it goes, but there's no continuous generating of income that's coming in. It's a good payday, but it like you already having to do something with that money's just sitting there. Either you're going to spend it on stuff that you don't need, pay bills, or you're going to reinvest it at that point. So that's why that idea of having multiple properties for me just seems like just a different stream of income coming in. Like I said, it all is all wrapped under real estate, but it's its own separate entity that's bringing us revenue.
I love it, man. I love it. And it's so instructive. How do you manage, though? That's a lot to manage. It would seem to me like it's a lot to manage.
Yeah, and that's why you can't sit there and try to do it all yourself. And we have property management in place, like even with Tariq, with the construction stuff that he does, like he has different people on different sites. Like you can't do everything as much as people try to, and really how the school system kind of lead us into, you're not going to be able to any aspect of life. You're going to need other people involved. Like no one is doing this by themselves. Even all the people that wealthiest people in the world and the different businesses or the real estate moguls out there, they're not managing this stuff all by themselves. They built a trusted group of people they can delegate work to.
Yeah, that's a good point. That's a really good point. One of the things that I share with people is that every person that's on top of their game has a coach and support staff. So if we look at any of our football, basketball players, they all have a coach and they have support staff. And I think if you're going to be on top of your game, whoever you are, we got to have our coaches and our support staff. So you talked a little bit about, your support staff, that you have property managers. Who are some of your coaches? Oh, before you answer that, I wanted to say code keepers. I did drop the biblical passage, Ecclesiastes 11:2. Divide your portion into 7 or even to 8, for you do not know which misfortune may occur on the earth. So it's saying you need to have multiple streams of income, 7 or 8. That's an interesting. It's a lesson. That's something my father taught me when he was still alive. Blessings upon his name. May his legacy continue to be a lamplight for success. All right, bro, answer the question.
Well, it depends. There's mentors I have when it comes to the CPA side of things or how to run business, and typically I have more than one mentor per thing that I'm involved with, because I think people teach in different ways, and I like learning from as many people as I can on different topics. So whether it's the tax business, or if there's the different type of real estate investments, because some mentors I had used to be or multifamily, but they don't really do any of the note investing stuff. So and then I have to find new mentors related to that. So that's kind of been the big thing for me now, where my newest mentors are Jasmine Willows and Desi or Arnez. That's more in the note investing world. So I give a lot of props of stuff that I learned from them and still learning from them as we're taking this shift in our investing ventures.
Ashe. Hey, I know we have some people who are tapping in, leaving comments. Code keepers, we appreciate you. We got Love Haskins who's checking in from Hawaii. All right. What is that? That's aloha. Aloha, love. We got the good brother Anthony Pickett who's saying hotel. So you get the peace sign. Let's see. Larry has been such an inspiration and motivation for me and virtual CFO pros. I had no idea he had so many streams of income. So awesome. So people are loving what you're saying, brother. People are loving what you're saying. Someone once told me to build a board of directors, advisors. Larry has been adding so much value to me in my network. Hey, you're doing it, bro. You're doing it. It looks to me like, in addition to you receiving wise counsel from your coaches, your mentors, just by your life and the way that you operate, you're doing the same thing for others.
Well,
Oseo,
that's a
go ahead,
flow of
bro.
life. Well, it's a flow of life. We're not here to just absorb a whole bunch of money or attain a whole bunch of money, attain information. Like if there's something I know that can help others, like I'm obligated to share it. Now there's a business side of it that needs to be done, but obviously, like I say, if you can be of value to people, I mean value begets value. I mean, that's so I see that as a huge,
Okay.
a huge responsibility for all of us.
I'm here for the money. I'm here for the money. Hey, let me see. Love also says he's seriously so knowledgeable. Yeah. So Larry, we talked a little bit about real estate. Is there anything that you would like anyone to know about real estate and maybe your services before we move on to our next topic? Like, if I'm interested, go ahead.
Well, regarding our services, we provide tax and investment coaching for people, and mostly it's been real estate investors, but for small business owners as well, because it's not obviously you need the investment to make sure it makes sense, ensure that it's right for you, but also you need to be able to keep as much as you make, as well. So that's where the tax coaching advisory comes from as well. There's always, you can't have one without the other, especially in this country. So you just want to make sure that you're, first and foremost, you're getting to investments that generate the return that you're looking to receive. And then how are you implementing strategies to help mitigate the taxes that the additional income was going to bring?
Good stuff. Well, we talked a little bit about real estate, and now we're going to move from real estate investing to the piece that blew my mind. So, you and I were talking, and you started saying that you were able to invest in people's medical debt, their vehicle debt, their credit card debt, their mortgage debt, and it just blew my mind that was an opportunity. It's not something I had any knowledge of, and of course I don't know everything. But I tell you, man, that just really opened my eyes. And then the podcasts that you shared with me have been really great as well. Give the story about how you first got involved in note investing. No, I'm sorry. Before you do that, let's give a definition, an operational definition of what note investing is, and then bring us up to speed how you got there.
Yeah, note investing really is short for mortgage note investing. There's different types of notes. My focus is mortgage notes. Anyone that owns a house, you have a mortgage to the house if you're still paying on that note. So the investing part of it is, can I buy? Like, is the buying of the note that you can make a profit out of? Because as we know, a lot of financial institutions, as soon as they get you under a mortgage, they're most likely going to sell it off and package it with other notes. And that may go to another financial institution, it may go to a hedge fund, but it typically is going to get passed around until someone's willing to hold that note long term. And we're always kind of focused on cash flow. It seemed like a good opportunity for us. When I first learned about this in June 2023, so as of this recording, a little over a year ago, and it just blew my mind that I didn't even know there's opportunities to actually acquire just the note itself. You don't have, obviously, you're not owner of the property, but you're in first position lien. Or you can buy a second position depending on what your comfort level is with that type of investing. But that's
wait. I think you may have used some language that some of the code keepers may not necessarily understand. So when you say first position lien,
mm-hmm.
Can you give a definition on that and then continue? I just want to make sure everybody's on board.
Yeah, so you go to whatever bank. I don't want to throw any names up here. So you go to wherever bank you need it. You put the down payment, but they're going to basically pay for the house, or give you a loan to acquire your home. So when they give you the mortgage, they have first position on the deed itself, because you have to repay back that note before you can fully take over, or fully take over that property. If you don't pay back that note, whoever's in first position can take over their property. Now this is this is actually after the city or locality that you in, because if you're not paying the property taxes, the government is going to take over the property. So in the sense of separate from the government part, when you're in first position, you have first right to take over the property if they don't pay you back the loan that you provide for that property.
All right. So let me see if I can bring it home to make sure I understand it correctly. Hopefully this will be helpful to some other code keepers as well. So the house that we own, when we purchased the house, is soon, maybe like 2 weeks after we did the documents. You know, we already moved in and had our little party and everything. We got a letter saying that the loan was sold to a different company. All right. So you're saying that the first institution sold our mortgage to the second institution.
Yes.
And that's okay. And so for the second institution, it was an investment. Of course, the first institution, it was an investment as well. But okay, so that's the note investing. And then first position. So when we bought the property, we had a first loan and a second loan. So would that be first position and second position?
But if the first loan, if the two loans are with two different companies, then the first loan is most likely going to be in first position. So
Okay.
if you don't pay your mortgage, they can foreclose on your home. But then if you have a second with a different whether it's the same or a different institution, once again, if you're not paying back that note, they can come after and try to foreclose on the property as well. Or if the second position, they could try to take over the first position because the second wasn't paid. It all just depends on the facts and circumstances of the value of the property and other things as well.
But it's basically who gets paid first, right? Who gets paid back first. Okay.
Yes.
Cool. All right. So you found out about this about a year ago. How has this changed your life?
It took me into really reflecting back, because we all talk about being the bank, but then you never really hear about banks owning rental properties. Typically, they got stuff in other real estate that they own, but they're trying to sell it off. And like that's truly really being the bank there. And I know people get into life insurance, and we're gonna go down that rabbit hole, but that's the real piece there, where it's like, hey, I'm a CPA, I'm an accountant by trade, so I like to mitigate my risk, so I can invest into this vehicle. Yes, I don't have ownership of the property, but I'm not responsible for any of the repairs, how it's set up. I'm not responsible for the taxes. I'm not responsible for the insurance. And I don't have a mortgage above me. I'm just making sure that I'm collecting payments, and I'm ensuring that the borrower is paying the taxes and the insurance to protect my asset. So I mitigate my expenses because I don't have as much overhead as actually owning the property. And I don't have as much liability because I don't own the property as well. So, I mean, there's still a risk involved, and I don't want to make it seem like it's all roses, but that side, the operational side of it, just really, really stuck to me and fits more to like how I want to invest.
That's intriguing, because another thing that happened with me and my family is we got a note in the mail, 2019. And the banks, actually, this was actually before the pandemic. It may have been about 10 years before the pandemic. All right, so we got this note in the mail, and the note said that the investor that held our mortgage was going to drop our interest rate for a certain amount of time. I think it was like 3 years, if we did not refinance. Okay, that's what happened. Yeah, the mortgage rates had dropped dramatically. And in a preemptive strike, the investor who owned our note contacted us and said, hey, if you stick with us, we're going to go ahead and reduce your interest for 3 years. And so yes, we will. We signed off on that pretty quickly. And I didn't realize that it was an investor who owned the note because we were paying Bank of America. And so we found out that Bank of America was actually servicing the loan and that an investor owned the loan. And so now it's all making sense to me. So you, me, any of the code keepers can purchase a mortgage note if they can get it. I'm not sure how you get it, and I want you to tell me how to do that because that sounds intriguing. I can then take the note and I can just hold on to the note, and the person who owns the home is going to pay the bank and the bank's going to pay me. They're going to service the note. The bank is just going to accept the money and then send it to me. Am I explaining that pretty correctly?
Well, there wouldn't be a bank in either. Like, yes, Bank of America is servicing the loan, but the loan servicer is not always a bank. It could just be, like in our area, you have loan care. A lot of people probably heard of face servicing. Like those are just loan servicing companies. So all they do is just making sure that wherever me as the owner of the lien itself or of the note, okay, hey, here's where the payments are supposed to go. Then make sure all the statements and stuff get to the borrower. The 1098, the year-end reports gets to the borrower, so forth and so forth. And they keep track of like communications if the borrower stops paying or they're not keeping up with the tax and insurance. Like that's what the loan servicing company is doing. So there are banks that do loan servicing, but that may not be always the case. So I just want to make sure, like really, when you're buying the note, you're basically taking the place of the bank in receiving the payments. Because you can actually service the loan yourself if you have the time to make sure all the monthly reports and all that and tracking of payments. You can service the loan yourself, just like you can manage your own rental property. I prefer to not do either one and just underwrite the deal and just put the right people in place to make sure that it's operating effectively.
Wow, this is a new area. Hey, so we've had a couple of other comments. I want to tap those in. So Serena Mann, the gorgeous Serena Mann says, Larry Pendleton, great information. All right. Okay. Oseo Katrina, she says, I own my home, but I'm a beginner. Good. That sounds like a VHDA loan, whereas the second loan is the down payment. Well, yeah, you were right. It was a VHDA loan when we did that. Okay. So, yeah, do tell. I love it. All right. Let's see. Can you talk about financing initial projects if you can't be the bank right away? You know what? Let's hold that question toward the end of the conversation. I like that question. Thanks, love. And enjoy Hawaii, love, man. So, Larry, you were saying that not only can you do that with mortgages on homes, but you can do that on medical debt, you can do that on credit card debt, and you can do that on, I guess, regular loans.
I mean, there's a whole separate world in just debt investing. And just as you, once again, taking the time to network and learn from others, and you just start to learn about these other different avenues. But I didn't want to get too caught up in the shiny object syndrome, so I just kept what I focused on, what I knew. I know real estate. So it's like, let's just focus on that. And yeah, so like cool people are investing in medical debt. Yes, people are buying up just different type of. If there's debt involved, there are other people that are willing to buy it because they have figured out a way to actually profit from it. whether they have the infrastructure in place to make the calls to people that they're trying to collect, or they can actually work the remodify the debt in order for the first person to start making payments. Because that's really what it is at that point. Like, can you acquire this debt at a discount, and then do you have the infrastructure to get this debt reperforming or performing that's going to work for you from a return perspective? And you can either sell it off or just keep cash flowing from there. But it's all but similar to buying actual properties, you make your money on the buy. You have to know what's your exit strategy, or what is like, or how you're going to get to that point where you could exit, or just continue to ride it out, depending how long you want to keep your money in that deal.
Katrina asks, what happens if the borrower doesn't pay?
Yeah, unlike rental property, when you're talking about eviction processes, is you have certain regulations, and each state is different when it comes to foreclosures. And typically, you're waiting at least 90 days before you can actually take someone through foreclosure. And this is where you want to get your attorneys involved and make sure everything is that you're following those steps correctly. Because if you're in a certain state, the foreclosure process can take you 2-3 years, and in some other states it can take you 6 months. It always depends on what state are you in. Are you familiar with those laws? Are you comfortable investing in that state? Because that is a risk that the person stops paying.
So how do you, as a debt investor, make money?
If I'm buying, typically I'm buying my notes at a discount. All this depends on each individual note. So one note could be a 3%, let's say a 5% interest rate on it, but I'm buying it at a 75% discount. Oh no, I'm sorry, at a 25% discount. So at that type of discount, my return isn't the 5% interest rate. I'm actually getting a higher return and making money off of that yield between what I'm actually making and what the actual interest rate is. So that's the part where, like, hey, based off of those calculations, how soon can I make my money back? How many payments that person has left? And then at what given point can I sell that note, possibly still at a discount, and still profit from it as well? So I'm making my money back, and eventually more so over the payments. So I'm thinking the long-term investment here, because I'm not really in the business of flipping notes either. But if I'm able to sell it at a profit similar to holding a property, I can sell it then. So I consider note investing pretty similar to rental properties. You buy, and then you're going to collect money off the rents. Same thing with the notes. I'm buying this note, I'm making my money off of the note payments. And then at any given point, I can either sell that property or sell that note. It's really the same. Visually, mentally, for me, it's the same. It's the same process, the same thought process at that point. I just have less expenses I have to really try to calculate on the note side.
That's crazy. So it's interesting that you can own the note and you don't have to worry about upkeep of the property. So the things that you deal with when you have tenants, you don't have that issue. Right. Your main concern is that the borrower makes their payment.
Yes.
And if I remember something else you taught me, is that in addition to buying and owning the note, you can also rent that note to another investor.
Yes. So that's a good way to put it, like renting out. So it's called partials, and there's other ways of terms of where, like, hey, if I got 10 years left on this note, I can sell off 5 years to somebody else, depending on how much money they're willing to make on it and how much money I can make off of that. Like if I'm supposed to be making X amount over that 5-year period and they want to pay me this amount, okay, cool. I can either wait 5 years to make that, or I can just take a discount of it now. So that person has those 5 years of payments And then after those 5 years of up, that back end 5 years is coming back to me. So yeah, so I'm selling up a partial of my note at this time in order to most is what most financial teachers are doing is they're selling off notes to recoup their capital quicker. I'm basically treating it the same way at that point. But I had this back end benefit of I'm still going to get cash flow at the end.
That's crazy. And I guess the crazy part is I wasn't aware of it. And it's all right. So look, I'm a newbie. You've already directed me to start listening to the podcast that one of your coaches has. I think it's called, what's the name of it?
I mean, there's a few different of them that I listen to. There's the Note Assistance Program. There's the Note Investor University. I can't think of there's a few others that I absorb from everyone because everyone says things differently, even though it's the same thing. It just clicks in a different way. So I just like to make sure I'm not missing anything, and that's where YouTube University comes in to help there, where you can start to kind of point out who's actually getting out good information and if you want to invest into their programs or not.
Interesting. So yeah, the one that I listened to was the Note Assistant Program, the two sisters, and yeah, they that was really informative. So Code Keepers, I would suggest that if you're interested in learning more about investing in notes, find Note Assistant Program, or what it's NAP. I remember that. So find that podcast and check that out. And those sisters are on top of things. So, Katrina, she says, how do I start?
Well, I mean, that's like the conference I went to. It was called DME. I couldn't go to the one this year, conflicted with another schedule, but I like just get exposed to it. Find a conference and try to meet people, or check out the whole bunch of different Facebook groups that's dedicated to no investing as well. Just a quick search and so many will pop up. There's some really good folks up there that kind of help people start, or at least kind of guide you if you want to not throwing a whole bunch of money into someone's coaching program. So that's where just kind of seeing what's on Facebook, seeing what's on YouTube goes a long way into figuring out, okay, what steps you need to take to kind of put yourself in position to learn more and actually take action.
Cool beans. Let's wow. I think we've kind of delved really deeply. Well, I do have another personal question myself. What's the lowest amount that you've seen in terms of purchasing a note? Because sometimes when we think of investing, we think that there's a huge barrier to entry, that you got to have money. We hear you got to have money to make money. So how much money would I need to get started? So what's the lowest note that you've seen somebody obtain? What's the lowest amount?
Well, I'll speak for myself that the first note I bought was for $800, and that was a partial. A lady from one of the programs, she felt comfortable selling off 12 months of her note to me for that amount. The returns, it really wasn't where I wanted to be at when it was all said and done, but it was a great learning experience to actually see that actually execute from beginning to end. From underwriting the note, all right, what's the process of those payments coming to me, whether it's going to come straight from her or if I'm going straight from the borrower from there. So it could be rather low. It's just the relationships that you're building along the way. That was my first partial note. My first note that I bought that wasn't a partial was $1,500. And that person had $4,200 left on their note, and they were paying about $125 a month. And so that for me, that was, and they still had to pay $4,200. They don't know that I bought for $1,500.
I just had to pause to let that marinate. So you're saying that I owed somebody $4,200 and you purchased the debt for $1,500.
Yes.
Whoa. But I still paid you back $4,200.
Yes. The person ended up paying because it was 6 years left on the note. The property was in Oklahoma. The person still had about 6 years left. So I was actually looking forward to seeing that ride the whole 6 years, but then ended up paying off early, like a 2 months, 3 months after we closed. So once again, they still had to pay off $4,200, but I only got it for $1,500.
Okay. So that person paid it off 3 months later, but they still paid you back $4,200.
Yes.
And if they would have gone 6 years and paid the minimum balance, they would have paid around $12,000.
I'll have to. It wasn't that high. I have to go back through the numbers, but it was projecting to be overall 197% return if they would have kept paying just $100-some a month over that 6 year period. But they paid it off early, so it ended up just being probably about a 40-some% return. Which, like I said, I'm not arguing with that. It's just now. It just actually seeing it actually helps me even more to better understand why I want to go into somewhat larger notes, because most likely people are going to pay that off longer instead of. But I wanted to do smaller notes to get my understanding and actually take action. You have to put money at risk. You mitigate it with your underwriting, but you still want to go through the process and see it through.
All right, I think that answers Katrina's question. And her question was, do I have to put up my money?
You don't have to put up your money. You're not going to get a loan from the bank because they're most likely going to just say, well, why would we loan you money to buy a loan? They can just buy the loan themselves. But there's 4 notes. So this is July. There's 4 notes that I'll be closing on over the next 2-3 weeks, and all of those notes I'm actually going to be in a joint venture with somebody else. So you can partner with other people to raise capital, and just make sure you're following all the proper guidelines when it comes to raising capital and what you're telling folks regarding information wise. But it doesn't have to be all your money, but you most likely will have to put up some money so you got some skin in the game if you're going to try to raise capital from other people.
Now, do syndicates and investment groups, do they do note investing?
Yes, you'll see a lot of like debt funds where that's primarily what they're focused on, is raising capital to take down larger portfolios. Typically, your Bank of America's, your Truist, your bigger banks they're not selling off notes one by one. They're selling them off, the good and the bad notes, in packages to these funds and syndicates. So yes, you can invest into one in order to get into the game that way.
All right. A Love asks, what does it mean to be mitigated?
You want mitigating the risk?
Yes, I'm sure we just needed an operational term so you understood because, hey, you give us some high level stuff here, Larry. You give us some high level stuff.
No, I mean,
Love went to ODU. She didn't go to Hampton. I'm just joking. Love. I'm just joking, Love. Mitigation is a Hampton University term. Okay, I'm joking. But yes, what does mitigated mean in this sense?
Well, all investments, I don't care what anyone said, there's going to be risk involved. So you're typically taking calculated risk when you're putting your money up or your time into anything. Well, so to mitigate your risk, how can I lower my risk involved with this investment? How can I ensure that I don't lose my shirt or lose all my money? So you're trying to make sure all the factors are taken into account to ensure that you put your money in the best position possible to get that money returned back to you, as well as get the returns that you're projecting back into. For instance, so one of the products I was talking about earlier, yeah, the $4,200 one, the actual property value itself, like if they would have just took that property and sell it, was roughly about $30,000. So I know that I mitigate my risk of losing my funds, because even if I have to foreclose on the property, I can sell it. I can take over the property, sell it at a discount less than the market, and still make my money back. So I lowered my risk of losing my capital because I know the fair market value of the house itself is way above what I'm paying for it, and still below market value if I had to take over and sell it, because I'm not trying to take over properties and turn them into rentals for me. If I have to foreclose a property, I'm just going to sell it off, because I'm mostly doing this out of state.
Intriguing. Well, you've talked about real estate. You've talked about note investing. And that, I'm telling you, that just the idea that you can do note investing still, that's a good idea. So you're also teaching people that they can invest their retirement funds. Where they do that at? I'm laughing because I'm joking, because I have an SDI. But why don't you give up the goods, man? Tell us the game. How can one invest their retirement funds? And I know that you'll be speaking on this later on tonight.
No, I did a webinar on that this past Thursday or Wednesday. It was Wednesday, this past Wednesday. So the general premise is that we have an idea that you can only invest in stocks and bonds out of your retirement accounts, which is only true if you're only got your funds in retirement accounts that limit you. So a lot of the bigger custodians, retirement account holders, they make their money off the commissions off the stocks and bonds that they have people invest into. So you're having to shift those funds out of those type of entity structures and put those into what's considered a self-directing retirement account. So you can have a self-directed IRA, you can have a self-directed 401k, you can even have a self-directed health savings account, or a self-directed Coverdale if you're investing out of that as well. But those type of accounts allow you the opportunity to invest in it's called alternative assets, but alternative assets is anything separate from stocks and bonds. So you can invest in what you know. You can invest in real estate. You can invest in various different things. I'm going to make sure I don't say anything wrong. I was about to say commodities, but precious metals is what I was thinking, stuff like that. But the whole purpose is that, one, you have more control of how your retirement account is going to grow. So you're the one underwriting the deals, and you're the one that's telling the custodian. And there's a whole bunch of different self-directed custodians out there that could be easily Googled to figure out which ones fit for you, fees and all that stuff. You just want to make sure you take into account as well. But you can grow your retirement account. The only issue that people may have with that is that you cannot take the money and personally benefit from it. You have to leave it in your retirement account. So whatever it grows tax free in your retirement account. If you're taking the funds out, you will be subject to additional taxes and penalties for just early withdrawals and just not properly using what the retirement account is for. The government wants people to put their money. The government wants people to basically have money for themselves when they retire. So they're not having to rely so much on Social Security and Medicare, which should not be someone's retirement plan. So to ensure people aren't taking money out of their retirement account and using it and not replenishing their retirement account, they put additional penalties and taxes in place to discourage people from doing so. But that still gives you the opportunity to grow your nest egg. Or if you want to work with someone else's retirement account, you can still benefit that way. If you want to, hey, you want to do a deal over here, you want to work with someone's retirement account, you can pitch them the deal so that they can be a private lender with their retirement account into your deal. So now you got cash flow that way, but you can't use your own retirement account to benefit now off of whatever deals that you're getting into.
Okay, so I have an SDI, and with that SDI, we use that as asset money to purchase properties that we buy, fix, and flip. I've also used some of my SDI to lend people money at an interest rate, 13%, 14%, as an investment, and then the money goes back into the SDI. So I don't personally benefit. I don't keep the money. I don't even keep the return on the money. So I think I'm doing the right thing there. So, but the crazy thing about it is people who are working day to day, who have, what is it, a 403B or a TSP, a 401k, they can take those monies that they've gathered, or they can take portions of those monies and use those for investing. And that's what you're kind of describing. I think that's so freeing.
Yeah, so that's the piece there where if you're talking about their current employer's 401k plan, there may be limitations. So I tell people just talk to your employer's custodian, see if you are able to self-direct. If not, you're not going to be able to do so. But if you have a 401k from an old employer that, or a 403B or TSP that you have yet to roll into your current employers, or if you're retired, just been sitting there, that's the opportunity to take those funds and get that converted into a self-directing 401k or type of retirement account that you have, in order to, once again, grow your retirement funds in stuff that you know and that you understand what you're investing into. And if you still want to invest in stocks, you still can. I don't want to discourage people from that. It's just a lot of people I talk to, they don't know how to invest in stocks, but they just got their money sitting in retirement accounts that's just investing in stocks. So it's like, you can still do it. You just now have more options in other investment vehicles to invest into, with a self-directing retirement account.
Intriguing. Let's see. We have a couple other comments I wanted to get out the way. Yeah, Katrina says, I've never heard of this. So yeah, Katrina, do your Googles, do your Bings, do your online research, and the information is out there. And then you have people like the good brother Larry Pendleton that you can tap into. So Larry, if you become my CPA, are you able to guide me through some of these processes? I mean, give me your elevator pitch, sell your services.
But no, I'm not really here to sell anything. It's all about the whole aspect of building passive income or building wealth and saving on taxes is a team sport. Like, you have to have the right team in place to help you get to that point. And I like to be a coach to people in that place where it's like, okay, I can't be a custodian for your retirement account, but we can get you referrals to people that can, and then start to get you all moved over that way. For people who are investing in rental properties and want to do cost segregation studies, okay, I can get you connected to cost segregation study people, companies, understand what they're trying to do, what they're trying to sell you, and just give you the proper thought process.
Whoa. What type of companies?
Cost segregation companies.
Cost Segregation companies.
Yeah.
Okay, I need a definition. I'm going to Google it, but let me hear it. What's a cost segregation company?
Well, it's funny because I was just talking to one earlier before this live. So before we even get into cost segregation study, you just got to know what depreciation is. So if you have a rental property, you can't just write off the purchase price of the property, which would be nice, but government doesn't like that. But you can recoup the building value over a certain period of time. That's what depreciation is. So, but that can be 27 and a half years. It could be 39 years, depending on how the property is being used. But if you're getting a cost segregation study, which is just an engineering report, the engineering report is then taking that property and breaking it into different components, segregating the different properties. So you get the benefit of accelerated depreciation and or bonus depreciation, which is just front loading more depreciation in the earlier years to get large deductions. And so so the cost segregation company, I say, is full of accountants, engineers, and salespeople that their responsibility is to take the property that you give them. All right, okay, what part of this property is 5-year property? What percentage of it is 15-year property? What percentage of it is 27.5-year property? And give you this engineering report that will allow you to take more deductions in the earlier years. So it's stuff like that I like to, once again, could we do it in-house? Possibly, depending on the size of the property, but I like to just bring in actual companies that specialize in it and help our clients understand, okay, here's what they're charging you for, here's what your actual tax savings are going to be, so that they can make an informed decision on if they want to pay that fee to that company or not, or go somewhere else, or just not do it at all.
All right, man. I'm learning a lot, good brother. I just Googled while you were talking. Grabbed my phone. Was like cost segregation. So there are layers.
If you have rental properties, you should at least be aware of it. I'm not saying that it should be done if you have rental properties, because sometimes it doesn't make sense for a lot of people. But it's important to just know what your options are if you're a rental property owner. This isn't something you can do for flips. So it's just one of those things that, yes, there's levels to it. Does every CPA or enrolled agent know about it? No, just to be honest. But there are a lot of us that do and specialize in providing that knowledge to people. And for me, it's just so that you can make an informed decision.
Cool beans. You also just used the term enrolled agent. Mm-hmm. And that's a CPA who's connected with the IRS, and you're able to do certain things.
No, so enrolled agents, like the certification they pass is solely just on tax. So that's the highest ranking tax professional that's out there. It's an enrolled agent. For the CPA, like our tests involve auditing, taxes, bookkeeping, financial reporting, stuff like that. So we're kind of more of a generalist aspect of it. But it was, for me, that's when I kind of took that pivot, probably about 7 years ago now, of just focusing primarily on real estate. Because the test itself, whether it's CPA or enrolled agent, doesn't really teach you about these type of strategies that actually help save on taxes. More so just compliance stuff. So whoever you're working with, you have to make sure, like, what are they doing to improve and educate themselves on all the different strategies out there that will apply to each individual. Because no tax strategy is a cookie cutter strategy for anyone. Everyone's going to be a bit different.
Right. Okay, cool. Hey, by the way, man, I love that shirt.
Yeah. How about my girl Kiva?
Look, you have cash flow is king is one of your shirts. You have invest in yourself, which you're wearing today. What are some of your other signature shirts?
Habits over goals is one. I'm trying to get value begets value is another one that I'm looking to start rocking as well. So just things to get people thinking about where they are.
That's dope. Hey, look, the last thing on our topic, on our conversation today, is going to be about this.
Say that they are living paycheck to paycheck.
You will be wealthier.
My wife and I were flipping our first house.
When you shift the way you see things, then your life is going to shift.
Money is a tool for what you want. Money is not what you want. You don't want money.
So that goes to show that you don't have faith when you do not take your money and put it into those accounts to earn interest. When you're scared thinking that something is going to happen, God says, who are you trusting in? Because I'm the one that has created the money system.
Well, I then got offered $350 million for my company.
It says you owe about $538,000.
That the individual and the individual family unit is responsible for filling their own cups.
I went from being homeless and living on the street to owning properties in Baltimore.
And that's why I decided to start a bank.
This is something that Martin Luther King spoke about.
Stupid mistakes and failures. We continued stumbling forward
because the Black community, for the most part, had to go in rent.
Yeah, so that's the trailer for the season 1 of Generational Flip. That's my documentary series, Generational Flip. You can find that at generationalflip.com. Larry, you're in episode 4. As a matter of fact, you're kind of like the guru of episode 4. You're teaching about debt investing in episode 4, which will come out in season 2. You got a chance to see episode 1 and 2. I would love to get your thoughts on it and why you volunteered to participate in episode 4.
No, I just like, even if I didn't see episode 1, I would have volunteered to do something like this, because it always did. And once I saw episode 1, it was okay. This is exactly what more people need. They need to hear other stories about people who are pulling themselves out of poverty, or pull themselves out of whatever situation that they're in, and just changing their mindset to do things differently, to better themselves, to better their families, so forth and so forth. So stuff like this goes a long way is going to connect to those who are willing to take action. A lot of people are just going to listen to it and not do anything, but for those who, the phrase sick and tired of being sick and tired, is like, well, you start to see all these different people who are action takers and start to build things differently. And I can guarantee them they did not do it by themselves as well. So you start to dig deeper into a lot of their stories. So I think what you're doing is great. Grateful to be part of it. I appreciate the opportunity.
Good stuff, man. Good stuff. How can folk catch up with you, bro?
I'm on all the social media. Well, not all of them. I'm on Facebook. I'm on Instagram, on LinkedIn. Larry Pendleton CPA. I try to keep it simple. You can scan this QR code over my shoulder as well. Take you to my landing page. You can see there's different other webinars, podcasts I've been on, different type of investments that we're in, and learn a little bit more about me and book a meeting that's convenient for you.
Cool. I'm on your website right now, and I think I'm going to drop that in the chat. So, I guess it's a link tree, maybe?
Yeah, it's basically all the same. Yep. But it's www.larrypendletoncpa.com, and it will take people straight to that.
Oh, okay. So give that to me slowly. www.Larry.
Yep.
Larry Pendleton CPA?
Yep.
CPA.com. All right, so let me see if I have this correct, because my fingers can get crazy sometimes, and then my dyslexia kicks in sometimes too. Larry Pendleton CPA.com is where folks can catch up with you, right?
Yep.
Okay. One last question. We're gonna make this the last question before we bounce. Katrina asks, have high interest rates cause you to earn less? That's an interesting question.
Yeah, I mean, it makes it difficult to acquire new properties because even though we're in the note side, we're still looking to buy rentals as well. I like to have a good balance of both for primarily for tax reasons as well. But yes, just the higher interest rates makes it more difficult to acquire more rentals, and then for the new construction projects that we have, the higher interest rates causes properties to sit on the market a little bit longer, unless you're having some type of special program or discounts for people to make up for those higher interest rates.
Oh, okay. What are those plans or strategies to help people make up for higher interest rates? I'm asking because I have a property on the market. It's been on there for 10 days now. So if I can offer some incentives to a buyer, I would love to know what those are.
We're actually looking to potentially do seller financing, and just making sure we adhere to the Dodd-Frank regulations to when you're selling to homeowners. So we're looking into stuff like that as well, and just obviously just covering certain buyers' costs and stuff like that to basically chip away how much they owe, take more of the closing agent fees and stuff like that, as well. As long as we're hitting our numbers, makes sense for us, especially if we know where the market is, but what the house is supposed to sell for. So if we know we can get approved for what we get sold at, just have to take some of the additional costs on the back end to incentivize buyers.
Cool beans. Hey, Code Keepers, hopefully you've enjoyed learning today from Larry Pendleton. If you have, then share this link. This show is going to stay on the Our Black Empowerment channel on YouTube. It'll also be on the Get On Code, Our Black Empowerment podcast in Spotify, Apple, wherever you get your podcasts. So I think I might keep it on Facebook too. Yeah, we're streaming on Facebook too. So you should be able to find that in the Our Black Empowerment Facebook group. So share the information. Let's make some more of us as wealthy as Larry is. And let's make Larry wealthier. Go to his website. Let me see if I can put it back up there. It was LarryPendletonCPA.com. Check out his services. It's obvious that he's very knowledgeable and he can help us the way he's helping himself. Let's all get wealthy. All right, Code Keepers, we love you. Keep doing the work. Stay on code. Stay on code. As we always say, get on code, share the code, teach the code, become the code. Our code is empowerment, which means that what you do today should empower you for tomorrow. Stay on code. Peace. All right, Larry, man. Thank you, man. I appreciate it. I got what I want.